Good morning, everybody. This is Kirk Spano, and it is December 10th. It is my number one boy's birthday today, so I'll be giving him a call after this. And I am in New Orleans. He's babysitting my dogs. Having a good time in New Orleans. It's an interesting place. I've never been here for a vacation. Passed through for a Super Bowl, passed through for a hurricane. And I tell you what, it's much nicer here now than it was 6 days after Hurricane Katrina, when me and a buddy drove some medical supplies and water down here. So it is incredible how much good food there is here. I mean, in just 48 hours, we've had 3 meals, and I'm just like, wow, I have to do this 12 more times before I leave. So I'm going to see if I'm up for it. We're going to go get some coffee over on Frenchman Street in about an hour and keep talking to people. I sent out a chat message a few days ago and mentioned that a little birdie told me something about something. It used to be that I talked to a lot of people back in I'd say from 2011, when I first got on Market Watch, to about 2016. I was regularly talking to hedge fund managers, corporate executives, private equity people. And after a house fire, 2015, I made kind of a mistake in one of my investments. I don't think my head was in the right place. And I started winding down my investment firm. And at the same time, I kind of went into, just writing on the side here until it became a real business. So at this point, the writing is a real business. And I've decided to regrow my investment firm. But for a while, I'd say for about 4 years, maybe almost 5, I wasn't talking to all the people I used to talk to. And here and there. But it used to be a weekly thing where I talked to 10, 11, 12 pretty significant people. And in the past year, I've started to do that again, talking to people who know things and people who know people. And I will tell you, that is what Fisher called getting the scuttlebutt. So in the book, Common Stocks for Uncommon Profits, which is one of the books I suggest you read, he has a checklist for buying stocks, and he calls it scuttlebutt. So you have to get the industry insights on companies. And I've been doing that this year. That's why the stock picks, even though they haven't all gone up so far, and we'll talk about that in a second, some of these stocks are going to be just world beaters. And I understand the desire to trade. And I understand that a lot of people get impatient if something they buy today goes down 10 or 20%. But that's why you scale in. And that's why you understand the companies that you're getting into. So there's this idea out there that you can't do good fundamental analysis, and that's just bullshit. I have been picking companies that became 10 baggers for 25 years. And I think that we have 6, 7, 8 of them in our basket right now. I can't tell you exactly which 6, 7, or 8 of them they are, but based on the businesses they're in and the odds of execution from these executives and maybe a little bit of good luck, we're going to have a whole bunch of 10 baggers. And the reason why I'm talking about that is because somebody in the Fundamental Trends chat mentioned a stock called Calyx. So when you want to look up a company over at Fundamental Trends or here at Margin of Safety, you just put in the symbol or keyword, and it gives you all the articles. So back in March 2018, I introduced Calyx to people. In June, I put it on the focus list. And these focus lists ended up becoming the plug and play. So now we do the quarterly plug and play. It just doesn't change month to month. Well, so in June, I told people 2018 buy Calyx and a bunch of others. If you go back and you read these articles, you find a bunch of stocks that did pretty well. And then you find a bunch of stocks that, kind of just did what the market did. And if you really think about, should I have traded these versus just buying and holding, doing a position trade, you realize that, man, it's probably better to buy and hold for years usually, rather than trying to get in and out from week to week or month to month. And that's why Shooter doesn't trade a big part of his portfolio. That's why I don't trade a big part of my portfolio. And I encourage you to only trade a small part of your portfolio, because the trading is what you do around the edges, and it's almost part of your cash. So if you're trading your cash, let's say you keep 20% of your money in cash like I do. I almost always have 20% of my money in cash, and I'll trade around the edges with that. So I'll say, okay, well, I like this stock or I don't like that stock, and I'll take 1% of my total portfolio and make a trade, and only expecting to hold that for a matter of weeks usually for me. And that's not where I make the big money. Now, I might add 4 or 5 or 6 or 7 or 8 points to the bottom line every year trading that little basket. But the reality is that 4 out of 5 people who try to trade fail. Why? It's because you're up against me and Shooter. I mean, you're trading against guys who have a lot of experience. So unless you're on our team, you're probably not going to do well. And if you've been following Shooter over at Fundamental Trends with his swing trades, what you're finding is, he doesn't make a lot of trades, but the ones he does, pretty high conviction, and they usually work out. So if you're an investor, right, don't suddenly think, I'm going to trade more, because you're not going to double your money every year. I mean, you'll have that year once or twice in your life, but really you're just looking to add an extra 3, 5, 10 points to your portfolio. And actually, we do that with just option selling, usually pulls that off. To be a good swing trader, you have really got to be a fantastic technical analyst. And you have to get a feel of what to do when inevitably the market puts you in a what-if situation. What I mean by what-if situation is, well, it looks like it's going this way, but what if it doesn't? And then you have to figure it out. So if you take a look at some of these stocks, I still had oil stocks on here and gas stocks at the time. And these oil and gas stocks are the ones that flabbergasted me and went up, down, sideways, around, crashed, reemerged, probably going to crash again. So I don't really pay attention to those. But the stock that somebody brought up was Calyx, which we were buying down at $6, $7, $8 a share. Well, where is that stock today? My internet's not quite as fast as it is at home. Here it is. It's a 10-bagger. I didn't even realize it was a 10-bagger because I didn't hold it all the way. Right? I sold most of my stuff in February, March, January, February, December 2019, January, February of 2020. So my question would be for people is, do you really think you could have out-traded this? If you had bought it down here at these low price levels, and see right here, it goes down. A lot of people bailed. Oh, I hate it. And then look, could you have out-traded that? Could you have made 10 times your money trading that? The answer is probably no, because it doesn't take much to miss a trade and then for the stock to run away from you. And that happens over and over again. So if you go through some of these old picks, Itron, that one soared for a while. For Solar, Micron, PayPal. I mean, wouldn't you love to have PayPal at 76? Sierra Wireless. I don't even know what Sierra Wireless is anymore. Sun Power, we were buying down at 6, 7, 8. That's one that I've held on to. Solar Edge, we were buying down at 45. Look at what some of these stocks are now. Right? Sierra Wireless is about the same. Solar Edge, 305. So that goes back to the old Peter Lynch thing. Right? All you need for a lifetime of successful investing is a few big winners. Then pluses from those will overwhelm the minuses from the stocks that don't work out. So a lot of those stocks that I showed you were, basically track the market, or maybe down a little bit, maybe up a little bit. But then you have your home runs. And when you make a good series of decisions, small decisions, over and over again, it tends to work out. So when I show you our plug and play stocks, and I show you all those charts from last week, and you go through here, like, okay, how many of these are going to be 10-baggers? And I'm telling you, a bunch of them will be. You don't have to trade them. You just buy them. Now, if you want to trade a real small percentage, kind of like a side portfolio, and that's actually how Shooter does it, then go ahead and do that. So I guess my message here today is there's a lot of noise in the market, a lot of reasons why bad things will happen, but the reality is that if you just buy these stocks and you understand these companies the way that I understand these companies, which I know you won't, so I've got a new way of writing about it, you will start to believe that it's okay to hold them through some volatility, because the rebound rallies and the catalyst driven rallies and all my stocks, if you've been following me, you know that every single one of my stocks has a stack of catalysts, right? AT&T, it's not just a 5G company, it's a fiber company. It's not just a fiber company, they got this deal with Discovery. It's not just a deal with Discovery, it's the fact that they're going to start competing with Roku. It's not just Roku that they're going to be competing with, it's that they have a satellite company deal that might make them a global 5G company. So think about that. When you stack your catalysts, or you talk about Ford, it's not just Ford is making cars, it's that they're going to probably be the number one EV seller in America, because the Mustang and the F-150, which is already the number one car, are going to sell tons. But it's not just that. They have a real estate portfolio that's pretty valuable that nobody pays attention to. Nobody puts any value on. But it's not just that. They have fourth industrial revolution technology that'll get them into some joint ventures, and that they can use that technology to do other things, and probably utilize the real estate that's going to have internal combustion engine cars no longer built there, to use their fourth industrial technology to do something else, either in partnerships or on their own, right? When COVID started, they started making ventilators. So that's what you do when you really understand a company, is you say, okay, what is the market valuing? What is the market saying I believe this company is going to be about? And usually, if that's the only thing, the company will be pretty fairly valued and there's no point in buying it. You might as well buy an index. But if there's another thing, or two things, or three things that the market's not valuing, and these things are more than likely to happen, it doesn't have to be 100% to happen, but if you have three things that are probably going to happen, say 80% likely, that means that there's at least two more things coming that the market doesn't value and is going to drive the price up. And with these small and mid-cap companies and a handful of turnaround companies, there's companies out there like that. And you only need about 30 of them. You don't need to own 50 or 200 companies. Now, if you're putting together little baskets like the satellite basket we have, maybe that pushes your number of stocks owned a little bit higher versus buying an ETF. But I want you to understand that some of these stocks that I've been buying, there's not really a great way to know what the bottom price is. You can kind of know what the bottom range is, and then you buy 2 or 3 times in that bottom range, or maybe once below or once above, and 2 times in what you estimate to be the bottom range. And then you hold, and you stop crying about, well, it hasn't gone up yet. These stocks will go up in the next 2, 3, 4 years, just like they always do when I pick them out. It doesn't mean every single one. It just means that enough of them are going to go up enough to blow away the market. And you just have to wait for it. I showed you the pictures about Exact Sciences, how that one chopped along for years, 5 years, 6 years. And then all of a sudden it was a 10-bagger. But he just kept building in that direction. The reason why you got to hold it that long is you don't know when the market's going to wake up and say, oh my God, look at this one, and then push it to the moon. You don't know. You don't know. And you can try to know, and you can try to figure it out, but there's so many surprises, positive and negative. And the narratives are so loud on the internet. Everybody's got an opinion. Everybody's got a magic system. I'm telling you that what Warren Buffett has said all these years works. All you need to do, and I know when I say all you need to do is hard, but if you know your companies, truly know your companies, and spend your time looking at their presentations. If you just look at the companies you own's quarterly presentations, you'll know more than 80% of the people in the market. Just that. Now imagine if you have some guy reading the SEC reports for you and reading the industry magazines and using an AI to get the information. Now you're going to know more than 98, 99% of the people out there. And that's a massive edge. So you can try to chase the market. God bless you. You got a guy like Shooter on your side, you're going to win more than you lose. But the biggest money is made buying companies that are going to be great when nobody expects it, when nobody understands it, when things are undercovered, when things are underappreciated, when things are misunderstood, and when the other people in the market freaking hate it. And that's when you buy. It's not any more complex or simple. understand what you're investing in, understand the total addressable market that they're getting into, understand how much money they can make. And you will find a lot of extra return. So the narrative today is that US consumer prices are in line with what everybody thought they'd be. What the heck does that mean? It means that everybody expected a big inflation number, but it wouldn't be anything bigger than we expected. So we got a 6.8% print for November. It's what everybody thought it would be. It's down just a shade from October. And things are starting to set up in the way that I told you they would set up. People are starting to think that inflation is going to be gone in about a year. Where have you heard that 1,000 times? By the second half of 2022 or the first half of 2023, inflation is going to be back down to 2%. It's probably going to happen quicker than that. The only thing that keeps inflation higher than that at this point would be if there's a spike in oil past 80-ish, which I guess could happen, but I don't think it's that likely. And how fast are Americans going to switch to EVs if it happens? Pretty fast. So inflation is transitory, even though they dropped the word. And they're using inflation as a way to get out of the money printing business until the next time you need to print money. That's all it is. So how does that impact the stock market? As liquidity comes out of the stock market, which Shooter put up a neat chart, and it's in one of my articles. As liquidity comes out of the stock market, right? Leverage will be harder to use. So that means a less levered market. You need one bad month to wipe out a whole bunch of calls, and then those accounts get margin calls, or they just have less capital to deploy. And there you go, you get your correction. Now, there are some big pieces of money that are going to be going to the stock market at some point. A lot of that money might stay in the market that it's in right now and just go to different places. And I'm talking about crypto. Ultimately, and Cody Willard and I and a bunch of others are on the same page here, 99% of the cryptocurrencies are going to a penny or zero. You're going to have a small basket of winners in cryptocurrency. Ethereum is the one that I like the best. They're going to be there forever because the nature of contracts and transactions is changing. And about a half a dozen of the companies we're invested in, and two that I just added back to the list, are in that world. So as we go through the cycles that nobody is really good at predicting, I'm pretty good at it, and I'm not even that good at it, right? Because there's no way to get it right enough unless you are able to get a piece of somebody else's pile of money to gamble with. That's how all the macro traders got rich. They had leverage or somebody else's money. They took an oversized cut via a hedge fund and said, well, I'm going to take your $1 billion and gamble it here, and I'm going to get 20% if we win. And if we lose, well, sorry about that. That's how people get rich trading macro. The way to get rich owning companies is to know what you're doing. And you have to understand that along the way, there will be black swan events that cause really amazing buying opportunities. Because every government in the world, every central bank in the world has learned how to juice things up, how to fix things pretty quickly. And there's a phrase that you should know from John Maynard Keynes. And it's the thing that hard money people and Austrian economist wannabes harp on all the time. Too much debt, too much money printing, blah, 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 blah. Inflation, blah, 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 blah. They've been wrong for 40 years. They're going to be wrong for another 40 years. They've been absolutely wrong, and they try to tell you they're right, even though in the face of it, you can tell the world hasn't collapsed. It just keeps on getting better. 2 steps up, 1 step back. 2 steps up, 1 step back. Over and over and over and over again. So there will be a step back, I think, next year, maybe 2. But then it's going to be off to the races again because there is a wall of money out there. And it's not necessarily going to go in the stock market, but it's going to go into rebuilding the world, which is what I've said has to happen. And I said it before Joe Biden, and then Joe Biden picked it up apparently from somewhere. I don't know, maybe we were in the same ethereal plane at some point. But as we keep building the world and making it more sustainable, and the wheel just keeps on going, the opportunity after opportunity after opportunity. And understand what the giant total addressable markets are. Cloud, from space data, sustainable building, sustainable clean energy, all these giant things in our 4-step process. Be on the right side of the giant secular trends. Stop trying to tell the world what to do based on your worldview. Accept what is happening. We are going to have a whole new financial system in the next decade. A lot of the old players will be the new players, and then there will be new players. We are going to have 10 times more clean energy in the next decade, maybe more. You're going to have half the energy on the planet sometime in 2030 solar. I can't tell if it's 2031 or 2039. I don't know. But between now and then, half the energy in the world is going to be solar. Oil demand is going to start going down around 2030, give or take a few years. Natural gas demand is going to start going down sometime about a decade after that, give or take. And one of the reasons will be because as we drill less oil, there's less gas to use, so we have to replace it. Coal's going to fall off a cliff at some point. I don't know when we get to that cliff. I mean, they're trying to get to the top of this coal mountain, and at some point it's just going to collapse. 5 years from now, 10 years from now, I don't know. But it'll happen again. And when it does, you don't want any piece of it. Not the mining companies, none of it. People ask about gold all the time. Look, I wasn't in gold for a long time. I bought gold in about 2001, rolled it up for a few years and got rid of it. Told people to sell their gold in 2012 in a Market Watch article, and man, that they hate me. I guess I owned it about a decade. Sold it like at $1,200 an ounce after having bought it at like $500. So it doubled my money in a decade. That's not that sexy. Some of the gold stocks have been to the moon and back down to nothing. Highly capital intensive businesses are difficult to run, and they're all cyclical. There's not a single one that's not cyclical. So when somebody asks me about gold stocks, I'll take a look at Barrick, I'll take a look at Newmont, but they're not great growth stocks, but they both have pretty good cash flow and should keep increasing their dividend. But again, I would tell you, focus on total return, not dividend yield. Focus on the stability of the growth of the dividend versus the dividend yield. And just put those simple rules in place. You'll make a lot more money. All right. I think that's all I got to say today. I will get this up on the internet sometime, maybe in the next hour before I go out for coffee. And we will keep talking about things as we go here through the gyrations of the market, whatever they are. I've got a new way of writing articles for you that should be pretty easy to follow. I got tired of writing a new title. Just I always got to come up with a good title. I'm just going to have a very simple article. Maybe I'll write a different title for the free side of Seeking Alpha. Just going to be however many reasons there are to buy this stock. 5 reasons to buy AT&T. 4 reasons to buy SunPower. 11,000 reasons to buy Ford. Whatever. We'll have the quick SWOT analysis at the top. The reasons why I like the company. And I will leave it to you to go look at the corporate report. I'm not going to regurgitate all this stuff anymore. It's a pain in my ass. It's not interesting. You can go read the corporate presentation. It takes 20 minutes. If you're going to invest your money in something, you can read a corporate presentation. It's a 30-slide, 40-slide slideshow. All right. Have a great weekend. I will get this up, and I'll be firing out a lot of articles when I get back. I got 150 started. So and there was 180, so you notice that I've been using them. Otherwise, I'm going to go get some gumbo, I think. Gumbo, it's all about the roux. That is what I learned last night in class. It's all about the roux. All right, take care.